Hello financial fans, welcome back to another stock analysis. Today we'll be covering Deere Co, stock ticker DE. Deere Co, also known as John Deere, is an American multinational corporation that produces a wide range of heavy equipment and machinery for agriculture, construction and forestry. The company's main products include tractors, combine harvesters, cotton pickers, planting equipment and utility vehicles. It also offers financial services to support sales of its products. With a history dating back to 1837, John Deere has become one of the world's largest and well-known manufacturers of agriculture and construction equipment. They're currently sitting at a $126.1 billion market cap, and in 2021 they generated a revenue of $52.5 billion. The dividend yield is currently sitting at 1.14%. 60% of their revenue is generated through agriculture products, 6% from turf, 14% from construction products, 7% from road building, 3% forestry, 7% financial, and the remaining 3% from other various income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety is based on financial ratios, financial health, and the growth of the company. We'll be using a standard margin of safety of 25%. This margin of safety can never be below 0%. Margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. First two metrics are the EBIT growth and the margin growth. EBIT has grown, going from $5.7 billion in 2013 to almost $10 billion in 2022. The average EBIT growth during this period was 11.5%, meaning barely no change in the margin of safety, but it almost qualifies for a 5% deduction. The margin has also gone up, going from 15.2% in 2013 to almost 19% in 2022. The average growth in margin was a very solid 4.3%, meaning a 5% deduction from a margin of safety. Next two metrics are the dividend growth and the payout ratio. The dividends have gone up, going from $2.40 a share annually in 2014 to $4.28 a share annually in 2022. The average dividend growth during this period was 9%, meaning it says 10% deduction from a margin of safety, but it's supposed to say 5% deduction from a margin of safety. The payout ratio is also still sitting at a very solid 18.7%, meaning a 5% deduction from a margin of safety. Final two ratios are the debt to EBITDA and the return on invested capital. Debt to EBITDA ratio is determined by taking the debt, subtracting the cash, and dividing it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. John Deere, this is very high. This is above 4 years. In this case, a 432% debt to EBITDA ratio, meaning a 5% increase in the margin of safety. The return on invested capital for John Deere is sitting at 10.2%, meaning no change in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of John Deere. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2013 to 2022. The average growth in free cash flow during this period was 15%, and I'm projecting a 9% free cash flow growth over the next 10 years. Or the next 10 years, rather. With this percentage, we can determine the future free cash flow of John Deere and determine the terminal year valuation using a perpetual growth rate of 3% and a discount rate of 9%. And making all of these free cash flows present value, we get a sum of free cash flow of $140 billion. And all that's left to do to get our equity value is add the cash and equivalents and subtract the debt, leaving us with a $93.3 billion equity value. To get our discounted cash flow price per share, all we have to do is divide it by the amount of shares outstanding, and we get left with a discounted cash flow price per share of $314.10. With the current price of $425.24, this leaves us with a downside of $111.14, which is a 26.14% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was 15%, and I'm projecting a 8% dividend growth rate for the future. And in this valuation model, we'll be using a discount rate of 9% once again. Then, doing the math on this model, we get a discounted dividend model price per share of $462.24, and with the current price of $425.24, we get an upside of $37, which is almost a 9% upside. The last model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to John Deere, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 14.42. All we have to do to get our fair value here is multiply by the earnings per share that John Deere is generating, which for them is $23.28 a share. And this leaves us with a fair value of $335.75. And with the current price of $425.24, out of this model we get a downside of $89.49, which is a 20% downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation price per share, which leaves us with an average out of these three models of $370.70. Without a margin of safety, we would still be left with a downside of almost 13%, but we have determined our margin of safety prior to this, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, reducing it by 5% for the margin growth, deducting it by 5% for the dividend growth, and deducting it by another 5% for the payout ratio, leaving us with a 15% margin of safety. Applying this margin of safety, we're left with a fair value of $315.09, and with the current price of $425.24, we get almost a 26% downside. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.